Welcome again to the Big Three Show from Global Money Talk. I'm Tai Wong reporting from New York City. On Big Three, I take a look at three news stories that I think are important for investors today. If you like this video, please subscribe, turn on notifications, and leave comments. If there is a topic you'd like me to cover, put it in the comments and I'll get to it on a later show. So let's go to the big three stories of the day. The first big story is, of course, the Fed decision. What did the Fed do today? And we're going to spend most of the show on that because it is pretty important. We'll also look at how the major markets did after the Fed. And finally, we're going to summarize what I think the key takeaways are from the statement and as well as the press conference. And finally, we're going to look at some of the lawsuits that President Trump and his administration have been hit with after all the changes they're trying to make in the beginning of his second administration. So, what happened with the Fed today? Well, the Fed didn't change interest rates. That was no surprise. Nobody expected any change in rates, so rates stayed the same. They said they were going to change, and a little bit of a surprise, they were going to reduce quantitative tightening, or QT, which means they're selling the bonds that they have bought. They're going to reduce that from 25 billion a month to 5 billion a month. So that change was a little bit of a surprise, and actually that caused a dissent from one of the Fed governors, Governor Waller, who's generally highly respected, and a little bit of a surprise. So the other thing they came out with was the summary of economic projections. So every 3 months, that's March, June, September, and December, the 19 governors and regional Fed presidents look at the economy and they project what they see for the next 3 years and in the long run. And the market likes to look at this because it gives them an idea of what the Fed is thinking. And given all the tariff volatility that we've had, the market was really curious to see what the Fed was thinking. So let's take a look at the new summary of economic projections. So at the top here, the Fed has marked down growth. So on average, it went from 2.1% for 2025 to 1.7%. So that's a fairly big drop. The unemployment rate they see only rising 1/10, which is interesting. I think in part that's because the labor pool is smaller with a lot less immigration and potential deportation. I think that will help keep the unemployment rate low. Most interesting is they see core PCE, the core inflation that they care about, up to 2.8% from 2.5%. However, in 2026, they actually see it not moving. They had it at 2.2. It remains at 2.2. So what does the Fed see? They see lower growth, higher inflation, and only slightly higher unemployment. Moving right along, let's take a look at what they're looking forward for interest rates for this year and the following years. Well, you can see that they didn't change their outlook. They still have 2 rate cuts priced in 2025 and 2 more in 2026. What did change was, even though the average didn't change, and that's how they get the median, the range is higher. In December, the Fed governors and presidents saw 3.6 to 4.1 range, but now it's up to 3.9 to 4.4. I should say that's the central tendency. It's where everything's clustered. The range actually was 3.1 to 4.4 earlier, but the bottom of that range is now up to 3.6. And you can see that here. You see these two people who thought there might be 4 or 5 rate cuts. Those guys have moved back up, and now only 2 of the Fed people think there are going to be as many as 3 rate cuts. So the average stayed here, but the range is substantially higher. And you see the range, the same thing for 2026. It was 2.4 to 3.9, but now it's 2.9 to 4.1. Even though the median didn't change, the range is higher. So the risk is for generally higher rates on a comparative basis. The market seemed to take that relatively well, as we can see. So how did the markets do? Well, everything was up, and something of a surprise. The biggest surprise, perhaps, was the S&P 500 finished the day up 1.1%, getting about half of that after 2 o'clock, after the decision and the press conference by Jay Powell. The 2-year yield, so the 2-year yield was down 6 basis points on the day, so bonds higher, yields lower. But what's really interesting was the 2-year was in the red. It actually rallied 10.5 basis points after 2 o'clock, so it really turned around quite a lot. The 10-year yield, also a pretty decent move. It finished the day down 3.5 basis points, but had actually rallied 7.5 basis points after 2 p.m. So these are pretty a pretty good performance by the bonds. And finally, gold also higher, up 0.35% for the day, but more of that, almost 0.5%, was after 2 p.m. So what this means is the market was happy with the Fed, and particularly happy with what Jay Powell had to say. So I'm going to give Powell a 10.0 on this. He really could not have done it better. And as a matter of fact, I think after he answered the last question, he looked very, very happy to get out and not have caused any volatility or concerns in the market. So why did this happen? I think everyone found the news that they wanted to see. I think the stocks liked the fact that the Fed only saw higher inflation this year, but back lower next year. So someone asked, is this going to be a one-off? And Powell said it may well be a one-off. Inflation when the tariffs come in, and then no more additional inflation thereafter. There is, as he said, a lot of uncertainty, but he actually brought back the word maybe the inflation will be transitory. And I think that's, he's maybe tempting fate here, because transitory was the word that the Fed used, that he used in 2021 when inflation really started to spike and they didn't think it would last. But finally in November of 2021, he said, you know what, I think we need to retire that word, and 2022 saw some huge rate hikes. So I wonder if he's tempting fate by bringing back that word, but I think the stock market certainly liked the fact that maybe this is a one-off in inflation and it won't flow through for years and years. I think bonds like the fact that there's going to be less quantitative tightening, so less pressure on yields going higher. Bonds, I think, like that, particularly in the 2 years and the 10 years. And I'm going to guess that the middle of their duration is probably around 6 or 7 years in terms of the bond market. So I think that helped the bond market. And finally, for gold, there's more inflation and more uncertainty, and the gold market is so bulled up that it doesn't really need an excuse to rally. It looks great, and we don't know what the ceiling will be now that we've gone through 3,000. So again, perfect 10 by Jay Powell. So let's take a look at the gold chart. Gold made new all-time highs as Powell was speaking, and if you look at chart, you can see the RSI. It is overbought, but if you look at 3 times over the past year, it can stay overbought for a long time. So I certainly wouldn't sell gold because you think it's a little bit overbought on the RSI. There's green fields ahead. We've never been this high. There are really no technicals here. So I think if you're a gold bull, you've liked it, you'll like it more after today. Now, I'm a little more concerned about the stock market. The S&P 500 up 1.1% to, I think, a lot of people's surprise. The stock market hasn't been healthy, although it has consolidated the last 4 sessions after hitting a low. But I don't think we're out of danger. I think the minimum we need to do is at least regain the 200-day moving average, which is this yellow line here. That's about 57.45 in cash. We're about 56.75 now. So let's call it a 1.25%, 1.5%. If we can get above and stay above the 200-day moving average, we may be able to consolidate, and the market some people might think that a low might be in place. Nevertheless, I think we're still in dangerous territory here. I think if you're looking to buy the dip, I still think there may be another down move. So what was the key takeaways from the Fed today? The Fed said uncertainty is unusually elevated. Not a surprise, but certainly something that they recognize. Now, this quantitative tightening, he said 3 times that everybody agreed on it, thought it was a good idea. he didn't mention Waller's dissent, but he said, we feel that there's some tightness in the money markets that helped the decision. We think it's just the right thing to do right now. Don't read anything into it. He said that 3 times in terms of monetary policy. So I'll take him at his word. And the Fed also seemed to suggest, given their economic projections, that the tariffs could create a one-time spike in inflation, and not have inflation going on through next year and the year after that. Now, if you remember, we looked at the Michigan confidence number late last week, and we saw that inflation expectations in 1 year and 5 years were substantially higher. And he's always talked about how important long-term expectations of inflation being anchored is. He said that again today. He said short-term inflation expectations are elevated, but the long-term remains well anchored. And he cited the 5-year rate, which is what the market sees the 5-year rate in 5 years as being pretty stable. Someone asked him about Michigan. He said, well, we saw it. We think it's an outlier. We don't ignore it, but we think it's an outlier. So right now, he's not worried about that, but I think you keep an eye on inflation expectations pretty closely. And finally, his view is sentiment is down, but the economy is not. It remains relatively healthy. Recession chances are up a little bit, but not a lot. So what's my summary here? I think the Fed would love to cut rates because they think we're well in restrictive territory, but they can't with inflation elevated, and particularly if they think core inflation is going to be 2.8%, rising from 2.5%, so they can't cut rates. What's interesting is former New York Fed President Bill Dudley, he came out and said, the Fed is flying blind. There is a lot of uncertainty. They don't know what's going on, so they really can't try to be proactive. They really have to sit on their hands and potentially be behind the curve. I'd agree with that. The Fed, I don't think anybody in the market knows what's coming, and the Fed certainly doesn't. So I think that's the takeaway. But the market liked the message that they saw today, at least until tomorrow. So moving along from the Fed, I put a couple of articles here from the Wall Street Journal. A federal judge blocks the Trump ban on transgender people in the military. Another judge blocked his trying to deport people based on the Alien Enemies Act, and that's from Reuters. Now, generally, I don't want to get into politics here on this show, but unless it impacts markets and economics. And I think we're going to actually potentially see that because the domestic policy fight is going to get messier. There are dozens, if not hundreds, of lawsuits that are pending against the Trump administration. A federal judge ruled that he couldn't close down the United States Agency for International Development, that wasn't legal. So everything's getting fought in the courts, and whoever loses is going to appeal. So fundamentally, I think the Supreme Court is going to have a really busy term just looking after these pretty important cases that are being tried. So basically the judicial branch has a call on this, but what's important is they rely on the executive, that's the presidency, to enforce their rulings. If the presidency of the executive doesn't want to enforce it or enforces it very lightly, there's not a lot they can do. I don't think Trump will want to defy the Supreme Court, but certainly he can drag his feet or do something very, very slowly. So on that note, let's just take a look at the court. And for people who don't pay attention to the court, I think this is worthwhile. So as many of you know, there are 9 justices on the Supreme Court. And if you listen to the media, most of the media says there's a 6-3 conservative supermajority. Well, that's not accurate. And because the Supreme Court has become very politicized and people are very exercised about that, it is not accurate. The real Supreme Court breaks down roughly into thirds. So there's the liberal wing, 3 justices in blue on the left here, Kagan, Sotomayor, and Jackson. They're going to vote almost always the same together. So they're the liberal wing. They will oppose every single thing that Trump does. The conservative wing, Thomas, Alito, and mostly Gorsuch. Thomas and Alito will generally side with the president. Gorsuch mostly, although sometimes he's a little strange. what's really interesting is the center right, and that's Chief Justice Roberts, Justice Barrett, and Justice Kavanaugh in the middle here. Even though Barrett and Kavanaugh were Trump appointees, they are generally relatively conservative, but they believe in judicial restraint. What that means is they don't think that the court should make policy. They're going to look and see if something is constitutional, if everybody's sort of playing within their bounds. So certainly they have ruled on things that Trump would not have wanted. He hasn't criticized them, but given the makeup of a court, which really breaks down into thirds, it is quite possible that you'll see 5-4 rulings against Trump. So things that get appealed to Supreme Court may not necessarily go Trump's way. Some of them will, some of them won't. And what this means is it could get very, very messy in the next weeks to months in the United States, and that has direct impact if there's a fight between the court and the executive. There's going to be a big impact potentially on the stock market and other asset markets, which is why we should pay attention and why there's this little tutorial about the court. Now, that does it for the Big Three today. Hope you found it useful. And if you like it, again, please subscribe and leave comments, and I'll see you again very soon.